Good morning and welcome to Columbia University's 19th Annual Social Enterprise Conference, Capital for Good. Columbia Business School has long been committed to advancing the practice and understanding of social enterprise, having trained leaders with a commitment to solving social and environmental issues for over 3 decades. By supporting new ideas from faculty and industry leaders and creating academic and experiential opportunities for students, the business school educates leaders to use business knowledge, entrepreneurial skills, and management tools to address social and environmental challenges. I'd like to show a quick video on some of the work the center does for the business school, the university, and our community in New York City.
Social and environmental challenges confront us locally, nationally, and globally. So how do today's leaders use business skills to create a more equitable and sustainable world? The Tamer Center for Social Enterprise trains the leaders of today and the leaders of tomorrow to help solve society's problems. We start by offering over 20 unique courses covering a wide range of topics, from traditional nonprofit governance to impact investing, to the intersection of business and society, to so much more. Many of these courses even take students beyond the classroom to witness society's challenges firsthand. Classes such as the Re-Entry Acceleration Program, or REAP, train MBA students to deliver business training to incarcerated individuals. And we know we have to do even more. We also provide seed grants to early-stage Columbia University-affiliated social and environmental ventures. And we offer additional real-world experience through fellowship programs, student-led consulting projects, and impact investing due diligence opportunities. But there's still even more we're doing to help create a more equitable and sustainable future. Capital for Good, our industry-leading conference, examines the financing and implementation of social impact capital. We host ongoing speaker events and forums for academics, alumni, and industry leaders to communicate and find sustainable, scalable solutions at the intersection of business and society. And we work hard to be the premier resource for students across campus pursuing careers in a wide range of industries. The Tamer Center is local. The Tamer Center is national. The Tamer Center is global. The Tamer Center is, at the very center of business, helping to solve social and environmental challenges. Learn more at bit.ly/ColumbiaSocent.
Today, we're thrilled to kick off our 2020-2021 digital event series, which will showcase social impact leaders in business, government, nonprofit, and philanthropy about the ways capital is sourced and used to generate sustainable solutions to global systemic challenges. We hope today's event and the upcoming events in this series serve as a hallmark in creating a virtual space on campus for the exchange of new ideas and best practices from mission-driven businesses and social impact leaders like many of you. Now I'd like to welcome my colleague from the Tamer Center, Diana Rambeau, who will join me on this virtual stage. Diana, over to you.
Good morning, and thank you, Bruce. I'd like to say how excited we are at the Tamer Center that so many people are joining us this morning to kick off the conference series. Many of us in the audience today have an interest in leveraging capital in order to generate solutions to global systemic challenges. I am excited and thrilled to introduce our keynote speaker and a leading voice for socially responsible investing, Amy Domini, founder and chair of Domini Impact Investments. Amy has received recognition for her thoughtful leadership in the field of impact investing as 2005's Time 100, 2006 honorary degree from Northeastern University College of Law, and honorary doctorate from Yale Berkeley's Divinity School, and 2008's Directorship 100 from Directorship Magazine. Amy is a past board member of the Church Pension Fund and of Epicureal Church in America, the National Association of Community Development Loan Funds, an organization whose members work to create funds for grassroots economic development loans, and the Interfaith Center on Corporate Responsibility, the major sponsor of shareholder actions. She is a member of Boston Security Analysis Society, and she has been a frequent guest commentator on CNBC's Talking Stocks and various other radio and television shows. Moderating Amy's discussion will be Professor Bruce Usher, co-director of the Tamer Center for Social Enterprise, and Elizabeth B. Strickler and Mark T. Gallogly, faculty director. Professor Usher teaches on the intersection of finance and social and environmental issues and is a recipient of the SPIDS Prize of Scholarship in the Classroom and Lear Award and the Dean's Teaching Award for Excellence. Bruce, I'll hand it over to you.
Thanks for that introduction, Diana. It's a little early in the morning to be going through all those titles. Terrific. And Amy, Domini, it's a real pleasure to have you with us here this morning. So we have about 30 minutes. I've got some questions for you to discuss the sector, the field of impact investing or responsible investing more broadly. And I want to kick it off with a one question to start us here. Just before we do that, I just see the symbol on the screen here. Are we in good shape, Diana, in terms of the video?
We're all set.
Terrific. Okay. So Amy, let me just start off the broad question, which is really about the sector at large, which is my question for you is, why does the world need impact investing or responsible investing? The title of our talk is Leveraging the Capital Markets for Social Change. Why do we need to do that? Why not just stick with our traditional system of investing solely for profit maximization? Leave it to governments and the nonprofit sector to address our social and environmental problems. What are your thoughts on that?
Well, thanks. And I think that's cutting right to the core of the importance of this field. I kind of like to start with the simple math. We have a means of kind of calculating what global trade is worth in the world. And it's got its pluses and minuses, but we always count it the same way, and we call that gross domestic product. And we're not probably hitting the targets for 2020 that we expected to be hitting, but call it in the area of $140 trillion going off of 2019 figures, maybe a little less than that. This means every time you go out and purchase a carton of milk, there's a transaction, and the value of that carton of milk is added up, and eventually all those transactions get you to this number. And it works out on a daily basis to being about $365 billion a day in transactions to get you goods and services. Some people call this the real world, as opposed, or Main Street, as opposed to Wall Street. The financial markets, on the other hand, dwarf these figures. We have New York Stock Exchange trades $170 billion a day. Currency trades are $6 trillion a day. NASDAQ 182. You add up these Chicago board, Hong Kong board, all the ones that are counted, and a great many are not counted, and you have something on the order of $7 to $8 trillion a day of securities transactions, and $39 billion a day of real transactions. So financial assets are trading on the score of 20 times more frequently than real assets. You now just imagine all of that pressure to just invest, as you say, for profit on the real world. I like to say, it happened in, I think, February 2016. A car crashed in California getting off the highway, a Tesla. Within seconds, that stock was down 8% in value. That Tesla stock was down. Coordinated, universal, instantaneous communications with perfect information, acting outside of government borders, of regulations of any one entity, without a single. This is what finance is capable of. It's a beautiful, beautiful tool for bringing peace, justice, ecological sustainability, and human dignity to all of us. And it is being left on the table. If it is allowed to continue to only serve making money, it's always going to be cheaper to not pay people than to pay people. It's always going to be cheaper to throw the trash over the fence than to dispose of it responsibly. And you will destroy people on the planet. But with this incredible system of instantaneous information that's so much more vastly active and perfected than real GDP, we can really make a difference. Now, I'll just go on for one more minute. Many
Please,
years ago, many years ago, I had the opportunity to moderate George Soros, and by the time at the end of the thing, he knew my field, and I said, "What is the number? How many investors do we need who believe that you need to integrate people on the planet surviving into investment decision making in order to make it true, in order to make it happen?" And he thought about it and he said, well, maybe 10%. And I figured, his off the cuff remark was probably better than a whole lot of scientific evidence. And ever since, that's been my goal, to get this to be at least 10% of the investing approach.
I'd say by some measures, we may have surpassed that goal, perhaps, depending on how you look at it.
And
we'll talk about that a little later, right? We'll see where we've gotten to.
Yeah.
And mainstream investors, but it's come a long, long ways, and it's really amazing how this field has changed. Absolutely. Well, I like the math. I like to start with a few numbers, and your math is pretty compelling. There's far more capital in the traditional markets than in, as you put it, the real world, and certainly far more than in philanthropy, which is a tiny drop in the bucket compared to this.
Right.
So that's really terrific. So of course, there's always pushback against these new movements and these new ways of doing things. And one of the, I don't want to say more aggressive pushbacks, but one of the issues that seems to come up with some frequency is this issue of fiduciary responsibility.
Right.
That investors have a fiduciary responsibility to maximize risk-adjusted returns for their investors, particularly for pension funds. So my question is, is there a conflict between the role of the fiduciary and the responsible investor, impact investor? I'm going to use this term impact investor and responsible investor interchangeably. I think we can agree on that, right?
Very tired.
A lot of terms. Yeah, I mean, far too much vocabulary, too many acronyms in this field. Yeah. But more importantly, so is there a conflict there in your experience? What are your thoughts on that?
So fiduciary responsibility is a concept that doesn't have a single definition. It has definitions within contexts. So there's one definition for pension funds, another for charitable entities, another one in France, another one in Germany. But overarching concept of fiduciary responsibility is that you are managing assets for the benefit of another person, generally speaking, could be entity, but another person. And going back to going back to 1830, there was a court case, a famous court case, Harvard versus Amory, defined it in a phrase that has come to be called prudent man, which dictated that it was a person who was investing as they would invest their own money, with an eye to preservation of capital and adequate returns on that. Now that definition pretty much held firm for close to 170 years. And it wasn't really until we got to a stage of the retirement accounts becoming self-directed that it needed to be updated. As long as retirement accounts were benefit accounts, in other words, the guaranteed account, retirement, you didn't have personal responsibility for making investments. That same watching out for the beneficiary, making solid investments in a way that had an eye for income and a return, but not an outrageous, that all held up. But once we started having in a manner of speaking, nobody in charge of whether or not those investments were being made well. We started to need to have greater definitions, and the Department of Labor, ERISA division, did begin to define these things. And within their definitions, they introduced the concepts that had been brought about in academics of modern portfolio theory. The core of modern portfolio theory argues that a diversified portfolio is less risky than a non-diversified portfolio. And it sounds like a simple idea, but it was shockwaves for the prior fiduciary. Historically, the fiduciary bought 30 good stocks. Now
life was easier back then. It was,
yeah. Now the fiduciary is buying commitment in long-short strategies that capture the behavior of emerging markets. And the fiduciary is buying, it was shockwaves in terms of fiduciary. And as that happened, there was a slight balance shift that went to, if you follow these rules, rather than if you do what a smart person managing their own assets would do. This has all led to a little bit more complication on the part of all of us trying to do it. But at the end of the day, your big out, no matter what standard you go with, is did you make money? Did you make enough money? So the core for my field has been, is it a good enough investment that a fiduciary, value blind, not caring whether they burn the planet, would also find it to be adequate financial returns for their needs? And that's been the goal for us. Now, there was a international study done. The United Nations Environmental Program commissioned Freshfield Strayhouse, very, very large law firm, to do a global survey on fiduciary responsibility. And that global survey did find that arguably in every geography, with the possible exception of the United States, consideration of the well-being of the lifestyle of the beneficiary was mandated. So that it went beyond financial well-being. It went, you can be rich and still not breathe. So every other place except America seems to have an understanding built into law that the beneficiary's well-being is more than just their wallet. In America, it's very focused on the wallet. That's a challenge for our investors.
Yeah. Let me dig into that, in America, how we think about it. I want to dig deeper, but just before we do that, I just want to understand where you're at. So what you're saying is, fiduciary responsibility suggested that as long as you maximize profit, as long as you're making plenty of money, you're going to be okay from a legal perspective. But this runs a little bit counter to intuition, which is, especially for investing pension money for multi-decades in the future, what good is it if we maximize profit for those pensioners if they're going to live in a world, as you suggested, is burned down? You can't eat those returns. That's the trade-off here. Okay, got it. So my understanding is here in the U.S., there's been some, as you said, a little bit of slightly different focus. And there were some government rulings back in 2015. The Labor Department, I think, seemed to suggest that specifically ESG investing, which is a form of impact investing, that it wouldn't violate fiduciary responsibility. But then just this summer, the Labor Department, President Trump's Labor Department announced a proposal that would prevent retirement plan fiduciaries from ESG investing. Any thoughts on why now the government's doing this? Why, in fact, not only have they not been very clear that there isn't an issue, they actually seem to now be going back to the way things perhaps work. When in fact, and the surprise here, I think, to many is that many financial firms are opposed to the proposal. I think literally thousands of financial firms have written the Department of Labor saying we don't support this proposal. Any thoughts on that? And this may be getting into political territory. I don't know what your thoughts are there.
This football has been playing out at the Department of Labor really since George W. Bush. And the reason is that even though ERISA only relates to these certain pension funds, we all kind of look to ERISA and say, well, those are the rules, so let's try to go with those rules. And the George W. Bush administration clarified a couple of letters which tightened the noose on responsible investing in ways that were quite alarming. In these two letters, the words best interest of beneficiary were replaced by best interest of plan, not beneficiary, the plan. So we no longer cared about people, we cared about the plan. So there was a big push under Obama to get that language rescinded. It happened in two letters. Obama did rescind it in one of those letters. That was a big cheer. Then Obama's administration also had they went after the more egregious, in some ways, short-term egregious issue that people who were fiduciaries were not acting in the best interest of their clients. They were steering their clients toward products that they could get more commission dollars out of. And that all got passed through in the last weeks of the Obama administration. The Trump administration, day 2, stripped it away, declared it, so 8 years of Department of Labor work went out the window, day 2 of the Trump administration. So this has been a political football back and forth. I don't think it matters. I think that Wall Street is increasingly recognizing a new value added, a new tool for making money. And they're not going to let that get taken away from them. What is going on is they're recognizing, and it's a little bit of a diversion, but I've got two companies in my mind. Both make consumer products that are sold in pharmaceutical type settings. You go into the store and you buy some insulin shots, and you also pick up Band-Aids and maybe cough syrup, possibly some candy, things like that. They very similar companies to each other, both pharmaceutical and over-the-counter kinds of things. One of them, 7 product safety recalls, 2 community controversies, controversy over the CEO compensation being overly based on returns. That CEO has been accused of raising certain drug prices in order to boost his personal bonus, and the actual dollars have been calculated back through. The other one without those controversies. What you learn from that data is very valuable stock picking information. From that data, you learn that one company is being run for one man's profit and the other company is being run as a company. And that is useful in picking stocks that go up. Wall Street's not going to let go of this newfound tool. This is going to be integrated into accounting standards very soon. It's already on the table, both in European and US accounting systems, as to how to have blended accounting that brings in some, the accounting standards were kind of frozen in time after the foundation of the SEC. We talked about earnings. We refined what earnings mean. We yammered, do you recognize a sale when you sign the contract or when the cash comes in the door? These kinds of things have been going on for 100 years. It's time to start talking about some other financial information, some other information that helps make financial decisions. And Wall Street's discovered this field does that. So they're not going to let go of it. And I thought an indication that this is true was the recent decision by the Securities Exchange Commission to raise the thresholds for filing dialogue with companies. So I can talk to management of a company if I do it right, if I follow the rules. Those rules got harder this year. For the first time in 40 years, they got harder. That was a tremendously controversial dialogue, and lots of people wrote letters to the SEC. They didn't get that much harder. I think that the SEC recognized that those rules serve investors very well, and maybe they were a little too easy, but they didn't make them very much harder.
Right. That's an interesting point you said about the traditional incumbent financial firms are not going to walk away from this. It's actually to their advantage. A former student of mine, he who now works for a large financial firm and is involved in impact investing, and he put it very clearly. He said impact investing might save active fund management. In other words, there's been this massive shift from active funds, stock picking essentially, to passive funds, just investing in index. And the problem with that, of course, as you know, for our audience, is that for the big banks, the big financial firms, you can't make much money as a passive investor. It's not very hard to do. Right. Computers do most of the work. And his point was, impact investing is hard. It's really hard to assess these companies and make the right decisions, and you get paid more for it, especially if you're good at it. And so that was his thought. And I think it's exactly what you're saying. The thinking about this field has really changed. Yeah. So let me ask another topic that again can be slightly controversial, which is the role of proxy voting in all of this. I happen to sit on Columbia University's ACSRI, another acronym to throw out there. That's the Advisory Committee for Socially Responsible Investing. It's the committee that recommends to Columbia's endowment, to our trustees, as to how to vote on all the proxies that come our way, on our direct holdings in our portfolio, our being the endowment's portfolio. So how important is proxy voting to responsible investing, and can proxy voting create social or environmental change? What's your experience with that?
Yes. I mean, I define my field as composed of three things. One is setting standards for what you will purchase, whether it's a bond or a stock or venture capital, you set standards. Another is engagement through the proxy voting, can be letter writing, can be some other, but direct engagement. And the third is this grassroots community development investing and attempting to water the grassroots deliberately. On this area of proxy voting and dialogue, it is extremely important in two major change ways. One is where there is an obvious shift in societal norms that corporate America has not picked up on. A situation 10 years ago was that many corporations in their public employment EEO statements, equal employment opportunity statements, would state that they did not act with disregard, or they did act with disregard to race, gender, faith, so forth and so on. They did not address gender orientation. I don't know, maybe 50 companies. My team and I telephoned and said, you don't address gender orientation in your EEO1 statement. We own XYZ number of shares of your company and we think it matters. We're willing to file a shareholder resolution on this, but perhaps it's just an oversight. And probably 40 of them said it's just an oversight. We'll take care, So good. Sometimes it's just cleaning up things that the corporate structure hasn't cleaned up. Other times it's very complex and it takes a very long time. And in that category, I would put something like sweatshops. we used to have factories overseas. A Ford Motor Company owned factories in South Africa, had employees in South Africa. They got Ford Motor Company paychecks. And nowadays, Walmart puts out on the internet, we need t-shirts. Somebody says, I can get you t-shirts. And Walmart's not owning the t-shirt making, and they're not, and yet terrible things happen in the factories where those t-shirts are made. And it's pervasive and it's universal, and it's in fact darn close to slavery in many places. It's darn close to murder in many places. It's got all kinds of ramifications. It took 10 years of filing a shareholder resolution, getting a little something, bringing together the NGO, the corporate America, corporations forming their own club to discuss these issues before we finally got to the point where we can differentiate policies from one company to another. We haven't solved the problem yet. We've gotten to the point where we can talk about the problem after 10 years of work. So those are the two key areas where I consider proxy voting to be particularly obvious. But sometimes I don't want to underestimate the value of a nice, clean issue at a moment in time. And I did personally engage a very large, one of the top 50 retailers that had garden centers that had plants for sale, and say, you know, I'm a gardener myself, and when I'm planting, you know, a little potted something or other, I don't want to be killing the honeybees. Your little potted things have been grown with neonics, which Europe at least thinks is killing honeybees. Don't you think you should at least be putting a sign on the flower that says, this flower may kill your honeybees, you know? And 2 conversations, and they started labeling. And they gave all their suppliers a 2-year window to stop using neonics. I mean, sometimes it's just so obvious, it just wasn't on the radar. Other times it's years and years. You're not going to get anywhere.
That's right. That's right. And certainly in the field that I focus on in this area, which is climate change, I think we are at a bit of a transitional moment with companies who are, I won't say labeling their products exactly, but they're really, many of them now are announcing plans to transition to lower emissions. And I think a lot of it does come through the proxy voting and their willingness to engage and talk about it. So I think your point about, you know, sometimes there's just a point where things change. It's a good moment to really do this.
You become an overnight success after 10 hard years.
Right, exactly. People tend to forget about those 10 hard years. That always goes that way, doesn't it? Let me ask you a different question altogether. You know, we were joking about terms and acronyms, but there's a lot of confusion just about basic financial instruments that can be considered impact investing. Some people, you know, just focus on equities, picking shares, that's impact investing. But of course, there's a whole fixed income market, which is much bigger than the equity markets. And you've got fixed income securities like bonds. What are your thoughts about that? What are your thoughts on green bonds, which is a subcategory that some people would say is a form of impact investing and others not so sure? That's a big market that's growing quite quickly.
Well, I years and years ago gave up on vocabulary. When I first wrote a book on the topic, I called it ethical investing. That drove people crazy. They would say, what do you mean everybody else is not ethical? And I was, well, yes, that's what I'm saying, you know, but so it was going through all this, but the my position here is that we need 2 basic goals to be in mind, and those basic goals are ecological sustainability and universal human dignity. Some people might call that people and the planet. And there are means of making these goals central to investments in every asset class. It is a matter of using those asset classes to make them central. Now, is this particular investment the best one? And you mentioned green bonds is a good example. Some green bonds are kind of light green, or they would have been done anyway, or whatever. But another phenomena that happened with green bonds is that by labeling the bond as a green bond, the issue sold faster and at a slightly better rate than that entity would have gotten selling it just as a bond. And that caught the attention of Wall Street. And they started going around recommending, well, gee, if you're going to build a new headquarters and it's going to be LEED certified anyway, maybe you ought to sell it, finance it by selling a green bond. You can get a better rate of interest and better payment terms and all this. And as that started happening, people started looking at it and saying, well, aren't there other things we can do with this concept? I mean, a lot of people need money to pay off their bail. What about bail bonds? What about having actual financing of things for social justice? So I'm not a person that believes you have to be the best in order to be worthwhile. Some of them I do get a little annoyed with. I think they're complete phonies. But the vast majority of them are on a path to making a real difference. And even, as I say, if their own particular product isn't that great, the fact that there's a market for it. Now, Domini Impact Investments has a bond portfolio that has very strong guidelines on what kinds of things we are looking for. We want to see that we are the people who are enabling the building of the something. Our sub-advisor to that is Wellington Management Company. They're one of the largest, maybe 4 management companies in America. Wellington Management Company gets to see every bond offering that comes out. But once they had our portfolio, they started saying, we want to see these bonds. When Wellington says we want to see these bonds, Goldman Sachs, JP Morgan, Sterling, all notice. So a little drop, a teeny thing like my teeny bond fund can have a much bigger impact out there in the entire world. So I do like them. This word impact has been confusing because it initiated, and I first heard it in a conference in Zurich in Europe. And in that conference, it was meaning venture capital. It meant starting new companies. And then it started saying, no, we mean in every asset class making a difference. So, far and away, the largest equity markets are New York Stock Exchange. And if you're going to try to get the biggest money, you need something that you can do on the New York Stock Exchange. And that is setting standards for what you will buy. And that is, I could argue the single biggest thing you can do to have an impact. But there are people who feel that building 200 windmills in Rwanda is the biggest thing you can do to have an impact. And people who think that filing a shareholder resolution that gets a corporation to put another woman on the board of directors is the biggest thing that you can do. So that's why there's chocolate and vanilla ice cream. People have separate ideas. We need them all three. In our industry, we call it a three-legged stool because if you remove a leg from a three-legged stool, the stool is not stable. It falls over. So we are very sure that we need direct dialogue with companies. We need to set standards on what we will buy, and we need to water the grassroots. Something like a green bond is watering the grassroots.
Yeah, and raising awareness of these issues, right? And that's incredibly important. And, you mentioned that sometimes those green bonds are, not the best. There was a couple of years ago in China where Chinese coal companies or utilities are issuing green bonds that was cleaner coal. They were more efficient utility. They were incrementally better than dirtier coal companies, but it was still coal. And, and they changed. The government changed the regulations after a little while and said, no, those don't count. So, yeah, it raises awareness and heads things in the right
that's
direction.
where setting standards helps. I mean, Domini doesn't buy coal.
Right, there you go. There's a green,
it didn't count as a green bond.
Yeah, those standards make a huge difference. I want to ask you one last question about career paths. Before we get to that, I see the Q&A button here has already about a dozen questions in it, which we're going to get to in just a few minutes. Take questions from the audience. But in the next couple of minutes, as I wrap up the discussion between myself and Amy, Dom, and I, if any audience members would like put any questions into the Q&A box, and my colleague Diana will take a look at those, and we'll try to get through as many of them as we can in the remaining time we have. So before we get to the Q&A, Amy, if you just talk a little bit about career paths for future impact investors. You've had an extraordinary career in this sector, really amazing what you've been able to do. What's your advice to students or recent graduates interested in this broad field of impact investing? It really is a very broad set of opportunities. What would you suggest?
Well, one thing they should realize how fortunate they are to be coming at this time. 20 years ago, I used to say, everybody I know in this field is the entrepreneur. They go out and start it because it's not a mature enough industry to have people hired in and all that. Now you have a broad range, and it's really across every kind of asset class. And you have corporate settings too. So when we at Domini Impact Investment, when we lose an employee, the single largest place we lose them to is corporations that want a person to be on the other side of the phone call from that shareholder activist that's in dialogue with. They want somebody who understands what the question is and has some credibility to be dealing with that. I mean, if you feel that you're the kind of a person that is most comfortable having a job that's 9 to 5 or roughly and has real clear-cut standards, and you don't necessarily on Sunday morning have to go racing off to save something, corporate setting is that, and the CSR officer within the corporate setting, and that comes in two forms. One is the person dealing with the investors, and one is the person dealing with the management of the company to bring that company's policies and procedures into alignment. As an example, MasterCard did not used to have a chief sustainability officer. MasterCard had inquiries from investors as to why their carbon footprint was getting bigger. They didn't really know. They figured it out, and the chief sustainability officer was the solution. Somebody's in charge of making sure that kind of thing doesn't happen anymore. Those kinds of students that are looking at that as an exciting path have to be comfortable with other people's rules. They can't be pure cowboy entrepreneurs. Right. The pure cowboy entrepreneur has lots and lots of opportunity in public settings now, and creating private equity settings, venture capital settings, being part of those tools. But you also in that field have to have a real keen interest in detail. You really need to know not only the why, but the why of the why, and the why of the why, and the why of the why. And then a huge sector is dealing with high net worth individuals. And there you better like people. You better like all kinds of people, because in that field, you get all kinds of people. And you have to have a very strong background on why you are picking the stocks that you're picking. The single biggest and most important course in terms of any of these careers, in my opinion, is financial analysis. If you don't have a rudimentary concept of financial analysis, you're at a disadvantage in any of these fields.
Yeah. Those basics are really important. Terrific. Diana, I'm going to turn over to you to take audience questions for Amy. Over to you.
Thank you. And on the topic of careers, Amy, what would be the 2 books that you would recommend for students and MBAs who are interested in getting into the impact investing space?
Oh, I'm not going to be able to give you the 2 books for, I mean, these days, I'm really thinking that it's video. I really feel as though it's these podcasts, these webinars, these networks. It's a very fast moving world right now. And I see, new books that are published, and they're pretty out of date by the time they get to press. I think I would start joining, and there are local groups all around where you get access to some of these webinars and some of these direct opportunities.
Any podcasts that you enjoy?
Say that again?
Any podcasts that you enjoy?
Oh, I'm of a generation that it's NPR for me, the podcasts. No, I'm of the old, TED Talks.
Exactly. There's a question in here from Ian that says, Bruce has alluded to the fact that there are many discrepancies between traditional investor returns and impact investment returns. Though it is a hotly debated topic, do you feel that you are sacrificing return by electing to make ESG and impact investments as opposed to traditional investing?
Well, a simple question is no. At the end of the day, I get to look at data that Calvert Mutual Fund gets to look at, and they're in the impact space, and the Pax World Fund, and they're in the impact space, and we come to different conclusions, just the way traditional investors all get earnings reports and come to different conclusions. And some people's conclusions are better than other people's conclusions. We at Domini took the management of our domestic equity product in-house just about 18 months ago. It had been sub-advised outside, and we launched a new product April 1st of this year. The domestic equity is meant to be like a Standard & Poor kind of a company, S&P 500 core equity portfolio. Morningstar has it in the 1% best category. It's 18%, and our new one that we started in May is meant to be a stock picking for, companies that solve a problem the world really needs solved. We call it solutions, sustainable solutions, and that one's Morningstar got it in the top 1%, and I won't even say the numbers, but it's crazy how well it's done since April. That's bad luck for me to raise that. But this is the Italian in me coming out. The evil eye will get me if I brag. But this is an area of keen interest now with impact investors, finding answers, solutions to problems. And what the coronavirus did was to put a stress on the system that made these answer-oriented companies suddenly highly desirable. I actually think in this environment of high stress, you're biasing the portfolio toward solutions to the high stress, and a better outcome should result.
Mm-hmm.
And if I could just add 2 quick points to what Amy just said, which, it is very controversial to Ian's question. I agree with that point, but the controversy has changed a bit. When I first started teaching this arena about a decade ago, the controversy was always, can impact investing returns equal traditional market returns? It was always like, are you going to lose, or can you just do as well? That was the big question. And now the argument is, do impact investing returns outperform traditional returns? It's like the whole narrative has flipped in favor of impact investing. And more the data suggests, to Amy's point, that in fact, it seems to be doing better. And with regard to the pandemic, the most recent numbers, we talked about green bonds a few minutes ago. Well, for years, green bonds tracked traditional bonds. They were identical returns. There really was not even a basis point difference. And since the pandemic, green bonds the index has outperformed fairly dramatically, given that fixed income securities, the pricing is fairly stable. So just the way that people are discussing this issue that Ian raises has changed a lot. Still very controversial.
Yeah, I did launch an index of our own in 1990, and it was at the time called the Domini 400 Social Index.
I remember that, yeah.
It did outperform the Standard & Poor by a statistically significant amount. And one of the sadnesses of my life, it transitioned and became property of MSCI and is no longer what it was. So you lose the long-term history, but for a good 20 years there, it was used as the proof that you could do better.
And both social justice and climate change are huge, and your impact investing standards have twin visions of human dignity and ecological sustainability. Do we have to choose which one comes first?
I refuse to. No, I mean, this is, now we're getting into real inside baseball. You didn't know that, but the system for deciding what's good enough to buy is different one house to another. And a great many places try to say, well, 4 points if this, 2 points if that, 1 point if that, negative points if that, add them all together, it's good enough to buy. And that implies that you're going to decide which is more important. Ecological sustainability. I've always taken the position, I'm not going to make a statement that it's more important to have gender diversity on the board than it is to have workplace safety, or vice versa. I take a much more of a pointillist approach to it. You throw a lot of dots up and then you stand back and read the picture. Now, we at Domini feel that those dots must include both of the core, must include ecological sustainability, indications of that, and must include indications of universal human dignity. But beyond that, we don't try to rank.
And how does impact investing complement philanthropy? Does it eventually replace philanthropy?
Well, of course, never forget that we shouldn't need philanthropy. So there could be that kind of a happy outcome. And there are parts of the world where philanthropy is largely mysterious because obviously that's government's job. So there's a little bit more emphasis on philanthropy in America than there is in much of the world. But in one area in particular, and that is this community development arena, this direct investing into something, for-profit investing into something, you certainly are, in a way, getting 10 times the philanthropic impact as you would get. I'll drill down into the complex, but I'm going to make it as easy as possible. There is a credit union there are many credit unions. One of them is called Self-Help Credit Union. It's in Raleigh, Durham. And if you make a deposit at Self-Help Credit Union, it's insured. You'll get whatever rate of interest a CD at a bank would get. It's the same thing. So it's sort of the equivalent of your money market account somewhere else. They're going out and they're making loans primarily to minority populations, primarily that have a cooperative business. They own a daycare center, they own a barber shop, they own something. They're cooperative housing environments. They are building a road to the middle class for their borrowers. Let's say I put 10,000 in, I get 10,000 back. I've had all $10,000 working all that time for social justice, and I still got my $10,000. So why the heck would I give it away in a philanthropic thing when I can do the same thing by having a community development bank deposit or a community development credit union deposit? So, at the extreme, I can see ways that it would replace philanthropy. I don't think that's happening. I'm just saying I can see a way it could.
And there's a question in here from Charlotte about what types of metrics do you typically or atypically use for impact investing measurement? I understand they might be highly specific to each investment, but is there a general metric that you use?
Yeah, this is going to vary one firm from another. Each of us feel very strongly about our secret sauce, just the way financial analysis think. One firm will say, well, we never buy a company unless it has a dividend or something. But we take a starting position with the industry and we look at what are the risks of being in that industry. What are the things that can go wrong in that industry? And by go wrong, we mean go wrong for ecological sustainability and go wrong for human dignity. We could say that in the oil and gas industry, we have seen throughout history ecological dangers. Throughout history, we have seen corruption, particularly corrupting of foreign leadership where the oil and gas is located. I don't think the public is as aware of the high rate of injuries of the workforce there, people working in oil, but that was a very risky work environment to be in. These made very easy things to judge one oil company versus another. Now nobody buys oil. Nobody buys coal, nobody buys gas. That's that whole discussion, but it's a nice high profile kind of a thing to look at. We would say that the only universal, no matter what industry we're in, that we apply to is we do look, to the extent it's possible, at diversity. And it is possible in gender, although people sometimes identify gender-wise in a way that's not obvious from their profile on their internet thing. And we do attempt to have companies that have diversity on their board and in their top management. That sounds like a no-brainer, so simple. I can't tell you how many companies it's eliminated from our buy list. It's pathetic. We have for 4 years been in dialogue with Japanese companies, and we believe that we are the reason that we're up now to 42 companies have added female to their board of directors that we've been in dialogue with. I'm not sure that would have happened without us. That happened because we were feeling we could not buy these companies because they had zero gender diversity at the top. And so we kept writing them saying, we love what you're making. We love it, but gender diversity matters to us. What's going on? Been two genders for a long time. And I'm sure they heard from a lot of people. I'm sure they knew the world was turning, but that one did go.
And the subject of gender diversity, how do you see women rising to the top into this field? And what are the biggest challenges for gender equality and women becoming investors in the impact investing field?
I think, as a general statement, finance is a wonderful field for women. At the end of the day, in finance, there are two skills that will create a path to the top. One skill is hard and one skill is soft. The hard skill is that you make investments that do better than other people's investments. You somehow have the capacity to be right a little more often than you're wrong. The other skill is that you have the ability to attract and maintain an audience, a client audience. That is it. Women are equally capable of those two skills. Now, you have all kinds of other societal things going on. Believe me, I know it. I did not have maternity leave for either of my children. It didn't exist. I went back to work after 1 week, a C-section, unpaid for that week each time. That was the world. So there are real problems that women face uniquely that men do not face. And those things have been making it more difficult. But I blame your competing business school to the north for a strong orientation that I consider a masculine orientation, but there's been explicit teaching that uses language that is male. And I'll give you a quote that somebody said to me at one point: when I'm making a venture capital decision, I just look at that guy right in the eyes and I say, is that the man to do the job? Now, okay, he's already eliminated half the potential entrepreneurs in the world. That's a problem that all women face. Yeah, that is going to be a problem that all women face. But in terms of the skill set needed, I think it's a great field because, in other fields you have bosses, you really don't have bosses in investments. Your boss is that you were right. That's it. So it's a great field.
And then for our final audience question, with the election coming up, do you see the election influencing the perceptions of fiduciary responsibility?
Yeah, this election is, I'm sure everybody's read the paper now. It appears as though Wall Street is hoping desperately for a Democratic sweep of all the houses, all the state legislators, and the presidency. And their reasoning is a little different than you might think. Their reasoning is that with these splits we've had, no matter, so long as one party couldn't get done whatever they wanted to get done, the other party was blocking everything they wanted to get done. There was no legislation getting through at all. And so I do think that this change will allow things to happen. I personally am working very hard, if it is a Democratic administration, on a couple of issues of fiduciary responsibility. I have tried for 12, 15 years to get this concept we talked about before, that we have to explicitly state that the duty is to a living being. The duty is not to a stock portfolio. The stock portfolio is a means to supporting a living person, but I think that is at the bottom of a lot of and I'll continue to campaign for that particular thing. I was the person in 2005, there was a head of the SEC, Harvey Pitts, who was considered very conservative and kind of not people didn't like him much. And I wrote him a letter and said, mutual funds are the fastest growing industry, run more money than anything else. And mutual funds don't have to tell the world how they voted their proxies. Portfolio managers have to tell the world how they voted their proxies. How come mutual funds don't have to tell the world how they voted their proxies? And Harvey Pitts thought, well, this is interesting. Let's get some commentary on this. So I sent my letter to this network, the Interfaith Center on Corporate Responsibility. And the Teamsters came right in and said, makes no sense. Mutual funds should be reporting how they vote their proxies. The SEC, this is prior to email land, so the SEC had more comments on that than that ever had. And mutual funds ended up having, Vanguard and Fidelity jointly wrote an editorial in the Wall Street Journal saying, we've come together to fight this stupid idea, and still the SEC decided to pass that rule. So again, never doubt that a few committed citizens can change the world. Indeed, it's the only thing that ever has. I'm quoting there, Margaret Mead. And I will continue to work on fiduciary responsibility issues throughout, yes.
Thank you. And Bruce, I'll pass the virtual mic over back to you.
Terrific. Amy, it's really been a pleasure here speaking with you. I think you've accomplished so much. Few dedicated people, and you're certainly one of them. Let me ask you one last quick question. We have about a minute or two left, and we're going to wrap up. But the field's changed dramatically since you've begun, and now the big incumbent players, Goldman Sachs has a division working on this, BlackRock has funds, and impact investing funds. Is that a good thing? How do you feel about this world we're now in impact investing?
To me, that's a good thing. To me, that's winning. The question comes up, oh, they'll crush you, they'll run, they're just going to acquire, they aren't real, whatever. But I've seen it often enough where what happens is it's an insider that begins to have more and more influence and becomes more and more real. There's a great big brokerage firm out there called Bernstein. Bernstein recently decided that they were going to have a specialty in ESG, and now they've got I get my little email each morning telling me about their ESG work that they're doing. It's going to be kind of a disappointment to top management in that company if they get a reputation for doing it poorly. They're going to want to do it well. They're in the business of doing things well. So yeah, I am. BlackRock voted against practically every environmental resolution they had last year. They've got a ways to go to learn. I recognize that. But I'm glad they're starting. I'm glad they're talking the way they're talking. I mean, it's everybody's welcome.
Step in the right direction. Yeah, that's great to hear, Amy. Again, thank you very, very much. I wish we were a live audience. You could hear all the applause, but okay. I'll just do it for everyone.